you mentioned, hey, I want to get exposure to the AI sector. How do you guys typically go about that? So like, I mean, obviously there's the, more endowment approach, I should say like larger institutions, and there's also the wealth management approach where you're working with an individual, maybe as, a couple $1 million, a qualified investor, if you will. But, generally when somebody wants to make an investment in sports equity, AI, how do you guys kind of generally recommend, or how do the RIAs kind of go about making those allocations? Is it one fund? Is it three funds? Is it 10 funds?
I think the beauty of the platform is that it is very dynamic and can specifically meet, many of the elements, all of the elements you're referring to. So an investor starts with their interests, and those are strategies or objectives, maybe their investment themes. And then we would ultimately not just buy one thing, because that dismisses the entire premise of diversification. And ultimately, one of the main benefits of this asset class as a general rule. So it's about having exposure to multiple funds. There's data out there that suggests that to mitigate permanent loss of capital, an investor of private markets has to have at least 9 investments. Now, we're big believers because we've seen institutional allocators have 3-4 times that through time, right? It's also how you generate a cash flowing private investment portfolio by having multiple investments, because we understand that it's a lot like dollar cost averaging. It's a lot like laddering, fixed income portfolios. You've got to make an investment in year one. And we refer to it a little bit like the seasoning, right? If you're going to have a barbecue or you're going to make dinner, you got to season the food prior to it being put on the grill or in the pan or whatever it is. And the same holds true for your PE or private fund investments. Year one investments, year two investments are going to take 2 or 3 years to marinate and exit that investment period, and ultimately for managers to start to realize those investments. So if you make a handful of investments in year one, a handful of investments in year two, then year three, by year 4, 4.5, the data is out there. Those typically start to generate cash flow. And then the year two investments in year 5, the year 3 investments in year 6, and so on and so forth. And then the burden for the advisor is on the sourcing part, because in order to generate the liquidity, it's to find managers that have historically been able to do that. And with managers who get to sit at the cap table, and with managers who have had the ability to continue to bring those opportunities to their clients, right? So there's those main elements. I got to find the right funds. I have to have funds that are delivering in many environments and in all economic cycles. And that's the value of being a private markets investor. It is really an all-weather strategy. And it just depends on identifying it within what time frame of an economic cycle we may be in. So, I mean, for example, if you're in an expansionary phase and we're starting to see 0 rates and there's significant growth, that's where VC and growth equity would be most in favor. If you find yourself in a contractionary period, then you start to look at lending opportunities. You start to look at distressed opportunities because of folks who went crazy in the expansionary period, now looking to offload certain assets. So there really has to be, for lack of a better word, an all-weather continuous approach to private markets in order for investors to really see the benefits. And therein lies the key.